E-mini has been sideways for several days, 60-minute chart, and it rallied strongly here, and then strongly briefly here, a gap up and a little bit of a bull trend with bad follow through in smaller bars, and now we're losing momentum. I think the odds are we're going to pull back, probably going into the FOMC meeting next week. Bulls have been able to get 4 consecutive bull trend bars on the daily chart, and yesterday was an outside day. Whenever you have an outside day, there's always an increased chance that the next day will be an inside day. However, yesterday's range was so small, I think the odds were against today being an inside day. So I think we'll either trade above yesterday's high or below yesterday's low, and possibly both. It could be an outside day. So we could go above yesterday's high and then below yesterday's low, or vice versa. We still have the big round number, 2,500, a magnet about 7 points above. We might get that. And today's a Friday, so I pay attention to weekly support and resistance. For resistance, the obvious resistance is the big round number, 2,500. And for support, the obvious price is this breakout price. Put it to a daily chart right here. We broke above a prior high, and the follow through, even though it's a series of bull bars, it's not very strong follow through. And this is around, what's the high of this bar? 2480, around 2487, so about 6 points below where we are, and the 2,500 big round number is about 6 points above where we are. So we're right in between weekly resistance, 2,500, and weekly support, the breakout point here. Today's a Friday. If we're within 4 or 5 points of either of those prices in the final hour, the market can quickly get drawn to the price. I'm sorry, I'm over here. I'm also trading Forex currencies, and I'm just checking. Okay. All right. Let me go back to this. Each of the past 4 or 5 days has begun with consecutive trend bars. We had 3 days with consecutive bull bars, and yesterday we had consecutive bear bars, and we still closed near the high of the day. We're opening in the middle of a 3-day range. That increases the chances that today will be another trading range day. I mentioned yesterday that the computers, especially the high frequency trading computers, keep changing the algorithms that they use. They monitor the profitability of the algorithms that they're using, and if one starts to become less profitable, they'll stop trading it. So they frequently change their algorithms every 1, 2, or 3 days, depending on what the market is doing. And you have to assume that whatever algorithms they've been using over the past few days have become less profitable, and they'll probably start betting on something different. We've been getting increasingly tight since over here, and the odds are we're going to start expanding. I don't know if we'll expand and get bigger ranges today. Obviously, next Wednesday when the FOMC announcement comes out, we'll get a big range. Right now, we're in the middle of a 3-day range. This is the 4th day of the range, and nothing to do. Buying above 1 is probably buying too high up in the range. Selling below 1, you're selling below a bull bar at the 60-minute moving average. So it looks like this is another limit order type of day. At least it's starting that way. I have a bearish bias, even though we've been going up for a few weeks, right? You know, this rally is much weaker than this rally, and the follow through has been terrible, and no significant pullback. So I think we'll probably get a pullback. Can we reverse down strongly? Sometimes that'll happen, you know, but I think right now I think that, I just have a bearish bias coming into the day. You know, we might get something like that and quickly get down to the support. This is that breakout point. This is the breakout, and consecutive bars, but they're not all that big. Follow through is bad. Follow through is bad. So we've broken out above a key resistance level, but the breakout has had weak follow through, and I think that increases the chances that we'll have to come back and test that support level. Again, I don't know if we do it today or next week, but probably soon. Also, this lack of consecutive big bull trend bars after 4 or 5 days reduces the chances that we're suddenly going to become very strong. And therefore, I think either we stay sideways or we start to pull back. I'm not getting lulled into the complacency of the past several days. I'm not, while I'm aware that we've been sideways for several days, because the market tends to not continue to do the same thing for extended periods of time, and we've been in a very tight range for several days. I think the odds are starting to increase that we're going to get some kind of a breakout, up or down, or both. Break to the upside, reverse down, break to the downside, reverse up. But I think we're probably going to get a bigger range today, even though it looks like it's a continuation of the past few days. I think traders should do nothing right here. They need more information. Probably buyers below. We have the 60-minute moving average below, even though I'm slightly bearish today. You know, the rally has been very weak without much of a pullback, and I think a lot of the bulls will start giving up and selling out of their longs. Traders bought the one low, they bought the two low. They wanted to buy around the moving average. I'm saying that we're probably going to get a bigger range day today. There's a slightly increased chance of a crazy day like this, simply because everyone is so accustomed to the ranges being very small. They're assuming that breakouts will fail. And whenever something is extremely likely, breakouts failing, it's much less likely than what you think. You know, if everyone believes one thing, it creates the possibility of a black swan event. And, you know, when you look at the chart, most likely we'll continue to do the same. And whenever something is clear like that, and it's very clear, you always have to be thinking that the exact opposite of what you believe can happen, and it's more likely, it has a higher probability of happening than what you might think. Here, the possibility of a huge trend up or down is not all that great. Here, it's not all that great, but it's becoming greater. We're in breakout mode, and now I think the probability is even greater still. Too many bars, you know, now we've had, over 200 bars doing the same thing. and that I think increases the chances that we're going to will change. For the bulls, they're hoping this is a failed breakout below yesterday's range and a reversal up from the 60-minute moving average, but a bad-looking buy signal bar. And for the bears, we tested the 5-minute moving average and are reversing down, but a bad-looking sell signal bar and just no momentum up or down at the moment. Limit order bulls who bought the 1 low made a 1-point scalp. Limit order bears selling the 3 high have not made money yet, even though 3 is a bear bar and we're right below the moving average. I did not take that short. We have a micro double bottom. We gapped down and rallied on 1. We went down on 3 and we're up on 4. Any reversal early in the day is a possible higher low of the day. This is a possible low of the day, but I think it's not a strong setup. 10-minute chart, you could see that's a bull reversal bar. So here's the 10-minute chart. We're in a bull trend and we're getting another higher low at the 60-minute moving average. And we have consecutive bull bars, but neither bull bar is very big. That is not a high probability buy. For the bulls, they have a bull trend, and then they see this as a pullback from this bull reversal, and they're looking for a second leg up. But the math is not all that good yet. Consecutive bull bars, only 1 bear bar in the first 5 bars, probably always in long. I'm currently flat. Everyone is eager for a trend day, but not enough evidence yet. I think we're always in long, so it's not a terrible idea to be long, but to me it's not a strong enough setup, and therefore I am flat. The bears will try to get a double top with 1, just like the bulls have a double bottom with 1. The bulls have a double bottom at the 60-minute moving average. The bears are trying to get a double top at the 5-minute moving average. Bears trying to get a double top reversal down from the 5-minute moving average. The bulls have a micro double bottom reversal up from the 60-minute moving average. Suppose 6 closes on its low, and then it would be a pretty good sell signal bar. You're still selling in a tight range just above support, yesterday's low and the 60-minute moving average. So unfortunately, the location is bad for a stop entry. Again, I'm slightly more bearish than bullish. The follow through has been bad after the break above the August high, and I think that will make some of the bulls start to take profits, and if the bulls are selling out of their longs, it increases the chances that we'll get a pullback. Still limit order market. Buyers buying below 1 and 2, selling above 3, but really small range. The bars are actually very small. They look normal on the screen, but when you look at the price, you say, wait a minute, these bars are really pretty small. For the bulls, a wedge, reversed up on 1, on 3, and they're hoping on 7 at the 60-minute moving average. And at some point, the bears give up. Right now, the bears are trying to break below support. Yesterday's low, 60-minute moving average. And if we reverse up here a third time, especially if there's a decent buy signal bar on 7, probably the bears will give up. And this would be the first good stop entry setup for the day. I think the bulls would want a decent bull bar, at least a 2 or 3 tick body closing on its high. Otherwise, I think a lot of traders will wait. The bears need at least a second strong bear bar. They have a decent bear bar 6. They would like 7 to be a big bear bar as well, closing on its low, below the 60-minute moving average. Since 6 is a relatively big bear bar, the bulls want a decent buy signal bar on 7 to erase the bearishness of 6. And I think the minimum that the bulls would need would be a 2 or 3 tick bull body closing on its high. Decent bull bar, it's a reasonable buy for a possible low of the day. Maybe 25% chance if it goes above 7 that we'll get a swing up. 75% chance we will not, but it's a reasonable trade. If traders want higher probability, they wait to see if we break strongly to the upside. Here we had a reasonable buy, and the market kept going down, right? Here, reasonable sell, and the market kept going up. Given this environment, we could easily trade above 7 and then trade below 7 and then reverse up again. We had a wedge here, we had a wedge here, we had a wedge here, and it kept going higher and then ultimately reversed down. What about selling on a stop below 7, arguing the bulls were unable to trigger an obvious buy? I think most traders should be waiting for one very big trend bar up or down, or a pair of consecutive decent trend bars up or down. Now, is it a higher probability above 7 after the market broke below 7 if it reverses up here? It's still probably a 25% chance that it will result in a swing up. And for the bears, they want to see a big bear bar, bar 8, closing far below support, the 7 low and the 60-minute moving average. Again, I think today is going to have at least one swing up or down. One thing that works against the bears here is bad sell signal bar 2, bad sell signal bar 5. When the market is in a trending mode and you get a swing, it usually comes from a decent signal bar. And we do not have that here, and I think that reduces the chances that this is the start of a bear swing. While it never seems possible, bar 1 always has a 20% chance of being either the high or low of the day. And right now, bar 1 still has a 20% chance of being the high of the day. We may have already seen the high of the day. Obviously, the bears need to do a lot to make that probability go up. You can see we're touching the 60-minute moving average, and that is the first time that we've touched it in several days. So it's a 20 gap bar buy. We did not get there here. We got close, but did not get there here. So bulls have been buying above the average price for 20 or 30 bars, and now they finally get a chance to buy down at the average price. So you'll have some bulls who had limit orders to buy at the 60-minute moving average, and they're finally getting filled. Bears trying to reverse yesterday's rally, but the absence of a good sell signal bar and the absence of consecutive big bear bars, and we're at support, 60-minute moving average. So I think most traders should just wait. Wedge opening reversal from above yesterday's low and at the 60-minute moving average. But just like the bears had bad sell signal bars on 2 and 5, the bulls have a bad buy signal bar, again, bar 9, just like bar 3. Whenever you get bad signal bars like this, it increases the chances that it's going to be a continued trading range. Bears repeatedly trying to sell off and failing every time. That's good for the bulls. Sometimes simply a single bar can make it clearly always in long or short. If the context is good and the bar is big enough. Here the context is good. We got a higher low, and we've repeatedly tried to break below the 60-minute moving average, and we've failed. This is the fourth or fifth time, depending on how you count. Decent bar, probably always in long. The bears still have lower highs and lower lows, so still a bear channel. But I think slightly higher probability that we're long. It would have been better if 9 was a strong bull bar. Is it by the close yet? It's probably okay, but I think a lot of traders will want a second consecutive bull bar, like 4 or 5 yesterday. The first hour ends in about 8 minutes, and the bulls want the first hour to be a bull bar closing on its high, a buy signal for a 20 gap bar buy. There's a gap between the low of this bar and the moving average, and every one of the past 30 bars or so has had a gap. And once you get 20 or more bars, the odds start to go up for bulls to buy the first pullback to the moving average, which is what we're getting here. Yesterday the past couple of days, we had a good buy signal bar here, sideways, good buy signal bar here, sideways. Bulls trying for a good buy signal bar here. Chances are it will not lead to a big bull trend day. Bears are trying to get it to fail at the moving average again, like at 1 and like at 5. And even though it doesn't look like much, it's important because a lot of bear trend days begin like this, with little reversals down that keep reversing back up, but the market keeps failing at the moving average. Still in breakout mode, probably always in long, but not very bullish yet. Bulls need a second consecutive bull bar, and they need to break strongly above the moving average. For the bears, what about selling below 11? Another failure at the moving average? I would not. I think 10 is strong enough so that there are probably buyers below 11. However, if the bulls do not get a good bull bar on bar 11, even if there are buyers below, a lot of traders will wait. Here we have to wait until the final second of the bar to find out if it's going to have a bull body or a bear body. Okay, so that is not bullish enough to make me buy. Failing at the moving average, failing at the moving average. became a bear trend. Failing at the moving average, got a swing down. Failing at the moving average, failing at the moving average, swing down. Moving average, moving average, moving average. And reverse down here, reverse down here. The bulls need a strong break above the moving average to make the bears give up. Final minute of the first hour. Bulls trying to get bar 12 to close at the high of the day to create a better buy signal bar. And the bears want the opposite. They want to keep a big tail on the top of the bar, reducing the chances that we'll break above the high of the bar and then rally. I think we do not yet clearly have one side or the other in control. I think we're still neutral. That's the close of the first hour. So when you look at that first hour, do you say, wow, what a great looking buy signal bar? Or do you say, why does it have that big tail on top? You know, something's not right. So it's a buy signal bar, a 20 gap bar buy. First pullback to the moving average in 30 or 40 bars, you know, maybe 30 bars, but a bad looking buy signal bar. And for the bears, we reversed up from the moving average and therefore not a very good sell below the low of the first hour. So first hour looks like a continuation of the tight trading range on the 60-minute chart. Bulls trying to get their breakout above the moving average and above the high of the first hour, and the bears want the breakout to fail and for the market to channel down. I think slightly more bullish than bearish, but the bulls need the strong breakout, otherwise we'll still be neutral. You know, I'm as eager as anyone to trade, but my goal is always to make money, and sometimes it's too difficult to do. So then my next goal is don't lose money, and it's easy to lose money when the market's in a 3-point range like this. So I'm going to wait to see what we get. I need more information. Becoming by the close, more and more traders believe we're going to go higher. Will the bulls get a third consecutive bull bar? If they do, I think traders will start buying closes, especially if it's a decent bull bar closing on its high. For the bears, a failed breakout high of the day and a wedge, 3 pushes up, 7 and 10. Too many traders selling the one high, and the bears are trying to avoid 3 consecutive bull bars. They don't want bulls to start believing that we're going higher. When I buy high, which I did not, I want to be relatively confident that the market's going higher. I don't want to simply buy because I'm eager to trade. After the first bar of the day, we reversed up above bar 9, and now we are reversing down below bar 14. That makes this a breakout mode day. Theoretically, bulls will now buy on a stop above 15, and bears will sell on a stop below 8, both looking for a breakout and a measured move. For the bulls, the measured move up would be from the low of the day to the 1 high, takes us up to the all-time high. Important here, right? Will the bulls prevent a bear body on 15? If so, it continues always in long. Okay, so that's interesting. You know, the bulls were able to prevent the bears from getting a bear body on 15. So I think we're still always in long. A lot of bulls bought the 15 close as soon as they saw that it was not a bear body. Bulls trying to get a gap and then a measured move up. NASDAQ, what are the chances of a big reversal down? It's small over the next few bars. The top of yesterday's range, but always in long. The bears probably will need at least a micro double top. Now what about the gap? Will we fall below the breakout point, 15 high? I would not be surprised if we did, because we're still in a tight range. However, I also still think we're always in long. And I think the first reversal down probably will be minor. Where's the stop for the bulls? Probably at a minimum below 12. It's kind of like a spike pullback channel. So I would put a stop below 12 or below 10. We're getting close to bar 18. And a lot of times, if the market trends into bar 18, you get a reversal. But this is a tight enough channel so that the bears will probably need at least a micro double top. Remember, on the daily chart, yesterday's an outside day, and whenever you have an outside day, there's an increased chance of an inside day on the next day. So today still could be an inside day, which means we could reverse down from just below yesterday's high. Right now, that does not look likely. It looks like we'll break above yesterday's high. And I also said today could be an outside day, which means we trade above yesterday's high and then below yesterday's low. You know, right now it looks like we've seen the low of the day, but you got to be open to everything. NASDAQ. So even if we correct, chances are the first reversal down will be minor. Now with a limit order, one tick below yesterday's high, I would not. The momentum up is too strong. You know, even though these bars look big, the entire range is still small. You know, the bars are actually fairly small. So breakout on 16 is only 2 points tall, which is not an especially big bar. So bullish, yes. And you know, probably will get follow through. But will it be a huge bull day? In terms of points, I don't think so. What happens at the measured move target? Okay, you might get some profit taking, but we're clearly always in long. Can this be a second leg trap like yesterday over here? We have a wedge and then a breakout. We have a wedge and a breakout. It's possible, but I think this is a big enough surprise so that the first reversal down, buyers will buy it. Profit taking at the measured move, profit taking new all-time high, profit taking yesterday's high. Still maybe a 20% chance we will form an outside down day and get all the way down below yesterday's low. 80% chance that's not going to happen. Where do the bulls buy again? Do they buy the low of the bear bar? I think we're always in long, right? This could be a second leg trap. We have a wedge rally and then a strong breakout, but we're still in our trading range. Strong breakout and series of bear bars became the high of the rest of the day. This is similar to today. A trading range look and then a strong breakout to a new high. And then we started to get bear bars. And we just entered a trading range for the rest of the day. By the close, it never got back up to that close. Will I buy the 18 low? Not if it closes below its midpoint. Too much risk of a second leg trap. Would I sell it? No, I'd wait to see if we start to get a series of bear bars. The reason I won't buy it if it closes below its midpoint is because of the risk of a second leg trap. Second leg trap, the market looks like a trading range and then has a strong breakout. And usually if you look to the left, the breakout is still within a trading range or not much above the trading range. And then you get terrible follow through and a reversal down. In a situation like this, I would wait to see if we get 2 or 3 consecutive bear bars before shorting. However, it's clearly disappointing for the bulls, right? A lot of the bulls will get out right here, below 18 if they did not already get out at the measured move target. You can see a lot of the bulls are panicking out here. I am back to flat, right? I'm not opposed to being short here, but the bar is relatively big, 18, so the risk is relatively big. Probability still favors the bulls, so the probability is low. And you have big risk, low probability. I want a second entry short or a series of bear bars. And for the bulls, because it's a possible second leg trap and terrible follow through after a break to a new high, I would wait for a second entry buy, like some kind of a micro double bottom. The bulls will try hard to avoid 3 consecutive bear bars. They might allow 2, but they're going to try hard to prevent 3, because they know that a lot of traders, once they see 3 bear bars and a reversal in the context is good for the bears, a lot of traders will start selling, sell closes and sell above bars, and that will make it difficult for the bulls to resume up. This is a comparable day where you have a very big breakout to a new high. And then the absence of bull bars for the next 2, 3, 4 bars, and then we get a breakout. But even with a big reversal down, the day still remained a trading range day. And so we even fell below the bottom of the breakout. So we even fell below the bottom of the breakout, but this is still a pullback from the rally. What kind of day will we get out of this? Well, we had a trading range for the first hour, and then we had a breakout lasting a couple of bars. A pretty big breakout, measured move up. Most likely this is going to be a trending trading range. So most likely we're going to be sideways for another hour or more. The minimum that the bulls want is the absence of 3 consecutive bear bars. And they'll probably succeed. So 20 probably will not have a bear body. If the bulls can achieve that, then I think the odds of a trending trading range day go up 60% or more. On the other hand, if the bears get a 3rd consecutive bear bar, maybe only 50-50 chance of a trending trading range day and 50-50 chance of a second leg trap, and we just reverse down the rest of, for the next several hours. But right now, more likely a trending trading range day. It could be a spike in channel up, so a spike pullback channel and a huge bull trend day. But whenever I see a trading range and then a brief breakout, 2, 3, 4, 5 bars, and then a pause, I think the odds are we're entering a trading range and we'll be in a trending trading range day. And if we do go sideways here for an hour or so, 60% chance we'll drop back into the lower range by the end of the day, which means 60% chance we'll fall at least a tick below the 1 high or the 15 high. This close is important. That's why the market is doing this. It's sitting with the doji bar, because everyone knows how important it is for the bears to get 3 consecutive bear bars. And the bears got the absolute minimum, right? They got the absence of a bull bar on bar 20. And therefore, a lot of the traders are confused. We have big up, big down. The bears failed to do what they needed to do. So that reduces the chances that we've begun a bear trend, and it increases the chances that this is going to form a trading range. On this day, did not get consecutive bear bars, 3 consecutive bear bars until here. But once we did, traders started selling above and we got the breakout. Today we have 2 consecutive bear bars and then a doji. Here, brief breakout and then trading range, trending trading range day. Brief breakout, really not much of a trading range, but we went back up into that range. Brief breakout, trading range. Small, brief breakout, upper range. Brief breakout, endless pullback, but basically an upper range. Brief breakout in a trading range. Bulls probably buying the 20 low. They may not buy the 18 low, but they might buy the 20 low. And bears, where will they sell? Well, they might sell above 21. I think they will sell above the high of the day, betting on a trending trading range day and betting against a spike in channel bull trend. So spike, pullback, and then bull trend. I think more likely if we do break above 17, it'll be a trending trading range day. All right, so here's bar 18, right? If we break above the top of the 18 range, 90% chance we will not come down here. There's already a 90% chance we're not going to come down here, maybe 80% chance. However, that does not mean if we break above 18 or the first 18 bars, the 17 high, that we're going to end up with a big bull trend day. I don't think that's the case. You know, the context is good for a trending trading range day. We've had lots of trading range price action, and therefore the odds are we'll have trading range price action today. And we have a brief breakout and terrible follow through. The breakout strong enough so that we'll probably go sideways to up, but all the trading range price action and the bad follow through, I think, increase the chances that we're going to go more sideways. What do you do here? Well, the traders are going to be buying below bars, below 20, below 19, and scaling in lower. And traders will be selling above bars. You know, I think I'm very confident they'll sell above 17. They might sell above 19. So we're probably going to be in a limit order market. You know, this range is only a couple points tall, and that makes it hard to make money buying with a stop above 21 or selling with a stop below 18. The bears need a breakout with follow through. Here they have a bear breakout and a close below the low of the past 15 bars or so, but bad follow through. I still think always in long. I still think a trading range is more likely than a reversal. The sell, two legs down, 1922. I would not. I would sell around the high of the day or above the high of the day. And for the bulls, I think of it more of a limit orders buy, buying below 20, buying below 21. And I think if you're buying above 23, you need a wide stop, at least below 12, maybe below the low of the day. Limit order bulls above the 18 low. Look at what happened, right? It's up only 4 ticks. Not a very good looking buy below 18. Obviously a better buy below 20 or below 21. Those bulls made their scalp, but the 18 low bulls have a 4-tick trap. And a lot of them will probably sell out as this is turning back down. And for the bears, I think some bears would sell the 22 high or the 19 high. I think more bears would be willing to sell a new high of the day. This is enough of big up, big down to generate big confusion and therefore sideways. So probably get a second leg sideways to down. 1, pull back, 2. The bulls will probably need some kind of a double bottom before they can attempt a channel up. The bulls want spike, pull back, and then bull channel for the rest of the day. However, more likely what they're going to get is breakout and then trading range for the next 2 or 3 hours. For the bears, this is a second entry stop sell. It's higher probability than selling below 18, but I still think the odds are this is going to be a trending trading range day. So swing bears can take this sell, taking a chance that we're just going to trend down for the rest of the day. Higher probability, wait to see if we start to trend down. More likely, we're going to get some kind of a double bottom around the 22 low and the 15 high. Trading range days, you often get second entry sells like this and second entry buys. We got a reversal up on 3 and then a second reversal up on 9. And we went up, and now we're getting a second reversal down. More likely, we're going to go mostly sideways. And as I said, I think it's better to be selling with limit orders above bars than with stops below bars. There's something interesting with the NASDAQ, very strongly up. And we accelerated up here 16, 17. So this is a buy climax. Its low is a magnet. And a lot of the bulls may wait to get down here before they buy again. I think even though it's an endless pullback and a pretty tight channel, I still think we're always in long. However, we may come down to the bottom of this buy climax before the bulls buy. If these bars and the range were bigger, I would be more willing to sell for a scalp below 18 or below 25. But the range is so small, it takes a relatively big move for the scalpers to make money selling with stops. They need the market to fall here, and that looks like a big drop. Even though it's only 6 ticks, based upon the appearance of the chart, that would be a pretty big pullback. With that second entry short, failed breakout yesterday's high, a lot of the bulls do not want to buy at the 25 low. They're trying to prevent a third bear bar. They were successful, bar 20. I don't know that they'll be successful here. Remember I said a lot of the stop order bulls would wait for a second entry buy, and they're trying to get that here with 27. I think the picture is confusing, and I think 25 being a good sell signal bar and good context, and 26 being a decent bear bar is enough to make a lot of the bulls not buy above 27. Too confusing. If you're buying it, I think you need a wide stop, below 12 or below the low of the day. Good bull bar for the bulls, always in long, but the probability is less than it might otherwise be because a trending trading range day is more likely than a strong bull trend day. And then, as I said, we have two decent sell signal bars, 18 and 25. So I'm going to wait. I'm not going to buy above 27. Another bar when we have to wait until the final seconds to see whether it'll have a bull body or a bear body. Can you buy on a stop above 25? The bears theoretically have their stop there. It's the neckline of a double bottom. I would not. I think probably sellers above 25, probably sellers above the high of the day, and we're probably in a trading range. Still always in long, so easier to make money buying, but I would not buy at the 25 low. It's a reasonable sell. I also would not sell because I think we're always in long, and I'm looking to buy again. Right now I'm trapped out. If 25 did not close on its low, I would have bought above 27. So right now I'm trapped out. Bears probably will start selling 25 high, betting on a failure. Bulls, 5-tick trap, but still always in long. Again, the bulls are hoping that 16, 17 is a spike and that this pullback will lead to a channel, but more likely we're going to get a trending trading range day. We've had a lot of trading range trading lately. We had a range for about an hour, and the breakout was brief and the follow through was bad. What about a stop entry short below 31 for a double top lower high? I would not. I think the bulls who bought 27 probably will make money, and therefore there probably are buyers below 31, even though bears will be selling above bars, above 25, above the high of the day. The bears who sold the 25 high are looking for a scalp. That means they'll be trying to buy back their short 4 ticks below, which means it has to fall 5 ticks below. I still think there'll be buyers below 31, and we'll go a little bit higher. Remember, at this point, right, after bar 18 or so, 90% chance we've seen either the high or low of the day. And right now, it's much more likely that we've seen the low of the day. An important bar, if the bears get a bear body, then they have a bear IOI and a 5-tick trap, and they might sell this as a lower high major trend reversal. I still think the best the bears get over the next hour is a trading range. And I think they would rather be selling with limit orders above bars, above 25 or above the high of the day, than with stop orders below bars, below 18, below 25, below 32, and below 35. It's certainly an okay swing sell, but I don't think the math is good enough for a scalp sell with a stop. The bulls who bought above 27 will probably get out below, right here, below 34. If they did not get out below 32, they have a 5-tick trap and now a second failure. Swing bulls obviously can stay long, but I think it's more of a scalping market. I think it's a trending trading range day, and I think we're in the upper range, and therefore it's probably better to be scalping, buy low and then take profits here. And for the bears, as I said, I don't think the math is good enough for a scalp. Had I bought above 27, I probably would have gotten out below 34. I might have gotten out below 32. You know, it's still always in long. Swing bulls can hold long, but because I think the odds favor a trending trading range day, given all the trading range trading we've had this week, I'd rather be buying low and scalping and not swing trading. At some point, those bull scalpers give up. I would have given up earlier. And for the bears who sold the 25 high, they've made their money. They have the 5-tick pullback, and therefore you'll have bulls buying around here as well. I think a lot of the bulls would like to buy lower, and I think the NASDAQ is interesting. We fell below the bottom of the buy climax, and the bulls are trying to totally reverse this very strong rally. They might succeed. Normally, the bears need 2 bear bars, 38 and 39. If they get it, then they'll have a 60% chance of a measured move down. Takes us down to the bottom of the entire buy climax. Do I think they'll get it? No, right now I think they will not get it. But if they do get a decent bear bar 39, then there's a 60% chance that we're going to retrace all the way down here. More likely 2 legs down, 1 pullback 2, second leg trap in what will become a trading range. Will the bulls buy the 27 low? They probably will. I think it's interesting that the bulls had a double bottom at the moving average and a 5-tick failure after that kind of a rally. You know, they only could get back to the close of bar 17 and back to the all-time high, and they could not get the extra tick. While it's still possible that this could reverse and become a bear trend, you know, a lower high, you can call it a lower high major trend reversal. It's really not major. I still think the odds are this will be a trending trading range today. It already is. We have a lower range, a breakout, and an upper range. 60% chance we're going to drop below the top of the lower range at some point today. You know, it certainly looks like it's at least 60% certain. You know, you can call it the one high. The market might instead decide that it's not the one high, that it's instead the 15 high, top of the lower range. I think it's probably the one high, but in either case, 60% chance we're going to get there, which means we're going to break below the double bottom by the end of the day. However, also, it's a trading range, and therefore bears will sell above things and bulls will buy below things, so probably buyers below 26. As far as buying the 38 low, I don't know, the range here is not even 2 points tall for 20 bars. I think most traders should just wait. For the bulls, a double bottom with 27 is slightly higher and 2 legs down, 1 pullback 2, but a really tight channel, really tight trading range, and a 60% chance that we're going lower at some point in the next hour. And that makes it a lower probability buy above 43. The math, I think, is bad here for scalpers. we know there's a 60% chance we're going to drop back below the top of the lower range, and therefore there's only a 40% chance we're going to go up very far from here. And then the upper range is only 2 points tall, so that's not much room for the bulls to make money. So I would wait. I would not take the buy. We're always in long. You could buy for a swing, but the probability of the market having a swing up is small, maybe 30%. It's a trending trading range day, not a strong trend day. And for the bears, they're still theoretically on their short below 34, but we have a small double bottom 38, 43, a decent bull bar. We have a double bottom higher low 27. I would get out of shorts. 5-tick trap for the bears who sold the 34 IOI. The market might wait until Wednesday to start having big swings again. I think the swings will begin before Wednesday, because if it waits until Wednesday, that would be an unusual number of bars in a very tight range. Wedge bull flag, double bottom 27, but very tight range, and still a 60% chance we're going to dip at least 1 tick below the bottom, below the top of the upper range, below the top of the lower range. So not good math for doing anything here. Always in long, so if you have to do something, you buy it, but I think it's better to wait. Next week, probably the ranges are going to get very big, and everyone's going to be missing these very quiet days. But the odds are next week we're going to get at least 1 or 2 very big days, big swing days. What happens once we get down below the 1 high? I'm going to put this at the 1 high. I think we're going below the 1 high. The day is probably going to remain a trading range day. If it falls down there quickly, traders will think it reversed the rally, and maybe we'll get down to the low of the day again. I think the 60-minute moving average will be support, and I think it'll be difficult for the bears to get below it. So I think the odds are against the day becoming a big bear trend day. Sometimes you have a lower range, a breakout, an upper range, and then it comes back down into the lower range. And then goes sideways. I think the issue is, will the bears get a breakout and reverse this and get a bear trend? Not likely. Or will we simply test down to around the high of bar 1 and maybe close around the open of the day? So I don't think the downside is very big, but I do think we're going a little lower. Still always in long. So some limit order bulls will buy the 27 low and scale in lower, but the range is only 2 points. Hard to make money. Plus there's a magnet below. Sometimes the market gets close to the magnet, like the 15 high and the 1 high, and then resumes back up after the bull breakout. However, when you have a trending trading range day, 60% chance you're going to get a dip down below the top of the lower range. So still 60% chance we're going lower. That lowers the probability for the bulls buying up here. Are we always in long or short? Well, even though we have a strong bull breakout and this is a high 2 buy and a wedge bull flag, I still think we have to go lower. So near term, I think we're going lower. Are we always in short? I don't know. I think, it's still a bull trend. The bears have not done enough to make it likely that we're going to go a lot lower. But this bear channel probably is going to go at least another point lower. Bulls trying to get trend resumption up. I think it's still better to do nothing. The bears have had a lot of time to get down to the open of the day, but with this reversing up, it becomes less likely. So if 64, the current bar, closes on or near its high, then the odds, I think, drop for a test below the 1 high. On the other hand, if it looks like this and closes below its midpoint, there would still probably be a 50% chance we're going to drop below the 1 high. For the bears, an ILI, failed breakout high of the day. For me, I'm not trading it. It's just too small. So I'm letting it go. The bulls are trying to get the weekly close above 2,500, but I think it's not worth trading at this point. That's the close of the hour. 144,000 or 140,000 contracts on bar 78. As quiet as the day is, that is a lot of volume. Here's the tick chart, 5-minute chart of ticks. Even though the market is sideways here for several hours, the ticks are mostly above 0. And when that's the case, it's really difficult to make money shorting. We stayed within a very tight range, and that made it hard to make money buying, but the bulls got trend resumption up at the end of the day. In general, whenever you see the ticks staying above 0 and the market is sideways, the market is going to either stay sideways or go up and not reverse unless the ticks start getting below 0. Daily chart, another bull day. Even though the 5-minute chart has been sideways for most of the trading of each of the past, 5 days all week, most of the day has been in a very tight range. Every day is closing at its high. And as you know, I always pay attention to closes. And when I look at the daily chart, I just see a bunch of bars closing at their highs, and that's bullish. And that increases the chances that we'll go at least a little bit higher. We still have 15 minutes left today. We still could get above 2,500 today. If we don't today, we'll probably get above it next week, especially with 4 bars closing on their highs like this. And we have a gap up here, a gap up here. It makes me think there's probably better than a 50-50 chance we're going to gap up above 2,500 on Monday. We have the FOMC meeting on Wednesday, and that will probably result in a big move. We're at the top of a bull channel, and in general, bulls take profits at new highs and bears sell at new highs and scale in. However, I would not be selling yet because we're not getting bear bars. A lot of bears, I usually don't like to sell the new high unless we start to get bear bars. And then once we start to get bear bars, I can sell or buy puts for small moves down, 10 or 20 points down. But when we're just forming bull bars and they're all closing at their highs, I can't sell. The odds are we're going at least a little bit higher, and therefore I don't want to sell when I believe it's going to go a little bit higher. Monthly chart, we have an 11-bar bull microchannel. For 11 months, every low is at or above the low of the prior bar, a sign of a very strong bull trend, but it's also unsustainable and therefore climactic. However, the first reversal down usually only lasts 1, 2, or 3 bars. Once you have a microchannel that lasts more than 5 or 6 bars, here we got a 6 bar, you got a 1 bar pullback, and then here 6 or 7 bars, 1 or 2 bar pullback. And here we have 11 bars. The first reversal down probably will just be 1, 2, or 3 bars, and then we'll get at least a little bit more up. So not a lot of downside risk over the next 1 to 3 bars, which means 1 to 3 months. And weekly chart, we're breaking out, and we have a bar closing near its high, that increases the chances that we'll go at least a little bit higher. Since we're right below 2,500, the odds are we're going to get above 2,500. Weekly chart, this is the last time the E-mini touched the weekly moving average. This was in November last year, and that is 44 weeks ago, or 45 weeks ago. We have not touched in 45 weeks. Although we got to within a half point here, we did not touch the average. It looks like we touched, but we did not. This is really, really unusual. And the E-mini has never been this strong relative to the weekly moving average in its 18-year history. However, no sign of a top. Because this channel is so tight, when we finally do reverse, the reversal probably will be minor, which means probably the best the bears can get is a trading range. The trading range might last a long time because this is so extreme, but probably the best they can get is a trading range. You know, maybe a 10% pullback, maybe down here we have a breakout here, maybe to the bottom of this channel. That would be about a 10% pullback. Today, another really quiet day. You know, every day this week was mostly sideways. Monday we had that gap up and rally. However, the second half of the day, the final 40 bars were sideways, 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 sideways. But every day is closing at or near the day's high. And, you know, again, closes are important. That means the institutions are buying into the close. And why would an institution buy into the close if they thought they could buy lower the next day? That doesn't make sense. And the reason why they're buying into the close is they're concerned that the next day might even be stronger and we may gap up. And it looks to me like we have a 50-50 chance of a gap up above 2,500 on Monday. On the open today, first bar of the day, a bull bar just below yesterday's trading range and a big tail on top. And it's a failed breakout below the range, but not a good reversal. A big tail on top could not get above the moving average. So it looks like we're probably going to have a trading range open. The bears got a second entry short at the moving average with bar 5, but a bull body, and the sell signal below 2, sell signal bar, a doji bar. So bad signal bars. And the bulls have, you can call it a wedge, 1, 2, 3, or 1, 2, 3. A wedge opening reversal up from the 60-minute moving average and above yesterday's low, but a bad buy signal bar 10. On 10, I said we might be always in long, and then I thought 15 might be the most interesting bar of the day. And why is that? Well, after the first bar, we went below the first bar and reversed up. And then bar 15 went above the first bar and reversed down. That put the day in a breakout mode situation. Theoretically, if the market goes above the 15 high, bulls will buy. If it goes below the 8 low, bears will sell. And the bulls, I talked about it, you know, near the end of the bar, right before it closed, it had a bear body. And then as soon as it closed, the bear body disappeared and we got a doji body. So that was the minimum that the bulls had to do to give the bears a reasonable argument for a high of the day. And the bulls quickly bought. As soon as 15 closed, they bought. And you can see the result was 16-17. It was possible that 16-17 was another second leg trap. Like yesterday, we had a channel and then a breakout, and that breakout was the second leg trap. First leg was the channel, second leg here, and that was the high of the day. It was possible that we did the same thing here, and it looked like it for the next 2 or 3 hours. We had a trending trading range day, a lower range, a brief breakout, and an upper range. 60% chance the market's going to dip at least one tick below the top of the lower range, the 15 high or the 1 high. 40% chance it will not, and it will either go sideways or up. And today was one of those 40% days. You know, we had a big high 2 buy, 2 legs down, 27 and 54, but not a good buy signal bar, 54. 57 and 60 closing on their highs. Better buys, but the probability not high enough for a scalp. So if you're taking it, you're going for a swing. Your stop is below 54, you're buying above 60, and I just let it go. And the bulls who did take it probably made 1 or 2 points, even though it rallied for another 20 bars. It did not cover a lot of points, and it probably would be very difficult to hold long. You might hold long below 74, but then 77 went down below 75. And I think it would be pretty hard to continue to hold long. For stop entries today, because today was mostly a trading range day, most of the trading was limit order trading. And, selling below 2, selling below 5, not great. Buying above 9, not great. Buying above 12, maybe for a swing, because at that point I think we're always in long. And then through here, I think it's not very good stop entry trading. Below 18 and below 25, reasonable sells for a failed breakout above yesterday's high and possibly a second leg trap. And the bears tried for the next 30 bars to get down into the lower range, and they failed. And then selling below 34, a second failed breakout above 25, reasonable sell, but probably not going to fall very far. And then buying through here, not great buying. You're buying in the middle of a tight range. But if I were buying with a stop, to me the buy was above 60. We have 2 bull bars closing on their highs, and we have a large high 2. And it looks like at that point we're not going to get down to the top of the lower range, and therefore we might get trend resumption up. So bull trend trading range instead of trend reversal down, we might get trend resumption up. Buy the close, sell the close. It's one of those trading range days. So what traders were doing is they were doing the opposite. Every time there was a big bear bar, they would buy it if it's near the bottom of the range, and a big bull bar, they would sell it, like the 17 close and the 33 close. And this is a little late in the day to do it, selling a 69 close, but the traders who sold 69 and 1 point higher made money, even with the bull breakout at the end of the day. Limit orders, we're probably not going to fall below the 60-minute moving average. On the 60-minute chart, we've been above the 60-minute moving average for more than 20 bars, and therefore bulls will probably try to buy at the moving average. So, bulls might buy below 1, below 3, not great. They did buy below 14, and 18 I thought was interesting. Whenever there's a strong breakout, but we're still, when you look to the left and we have not broken strongly above prior highs, there's a risk of a second leg trap. And when that follow through bar 18 closes on or near as low like that, I do not buy that 18 low, because sometimes it can just pull back endlessly like the NASDAQ did. Okay, huge rally. And then you have this bear bar and you say, well, Al, isn't it by the close? Yes. Isn't it by the low of 18? Doesn't the market likely, won't the bears need a micro double top? They might, but whenever you have an extreme breakout and then a big bear bar closing on its low, I'm never going to buy that 18 low, and I'm not going to buy 1 point lower or 2 points lower, because there's too much risk of an endless pullback and the market never coming back to my entry price, and I just find myself in a position with a loss that just keeps growing all day. And that's why in the E-mini I would not buy the 18 low. And then here, yes, it's limit order trading. Traders bought the 19 low, they sold the 23 high, and they bought the 27 low. And they even made money selling the 36 high if they scaled in higher. But late in the day, I'm not going to be trading with limit orders. And I did not trade any of this. I just waited it out. When the range is 2 or 3 points, I usually stop trading, because my goal is to make money, and it's too difficult to make money, and it's very easy to lose money. Your risk is always going to be bigger than your reward when you're trading like this, unless you're swing trading. But if you swing traded a short below 34, Do you get out of your short anywhere through here, or do you get out at a new high with a loss? So it's just really, really hard to trade it profitably. So I let it go. Anyway, I think very good day, very good week, very good month for the bulls, and I think we're going higher. Okay, question. I've been in the room for a couple of days, and I traded the NASDAQ, and I had over $2,000 profit at one point, scaling in 3 times on the swing down, but then lost all of it when it pulled back and stopped me out. Why did it pull back so hard? That's exactly the point I was making, that whenever you have a buy climax like that, that's extremely strong, and then you get that for a follow-through bar, a bear bar closing on its low, or with a 1 or 2 tick tail, small tail, I automatically 100% of the time get out, because there's too much risk of an endless pullback where it just keeps pulling back and back and back and back. If I do not, let's say the tail on 18 was bigger, let's say the close was around the midpoint of the bar, or even above the midpoint of the bar, would I get out below 18? I might hold, but if I see 3 consecutive bear bars, I get out 100% of the time. I'm not holding because there's too much risk of an endless pullback or reversal. And 16, 17, you look at the chart and you say, wow, those are really good looking bars, 16, 17. And you think, and you say, wait a minute, they're pretty good looking bars, but they're pretty late in a bull trend. And whenever a bull trend gets extremely strong after 20 or more bars, here it was after 14 or 15 bars, but after 20 or more bars, you got to be thinking that the strength is more likely a sign of exhaustion instead of an acceleration into an even stronger bull trend. And that's another reason to get out below 18 and then wait to see what the bears will do. You wait to see if the bears can create an endless pullback, in which case you don't buy, or you wait to see if the bulls can prevent the bears from getting 3 consecutive bear bars. You wait to see if the bulls can turn 19 into a bull bar or 20 into a bull bar, if the market can go sideways instead of down. And when I'm seeing this, okay, now we got a 6-bar bull microchannel, a little reversal attempt, but far above the moving average, and a small doji, not a good buy. And then we got another 3 bear bars. You got a high 2, but a very tight bull channel. There's no way I'm going to buy that, right? And the bulls are trying to get a reversal up, but after a 10-bar tight channel with only a single bull bar, this is probably a minor reversal, which means we're probably going to get at least a second leg sideways to down. I would rather wait for the second entry before buying. Okay, instead of a second entry, we have a bear breakout. Bad follow through on 39 usually means we'll try to bounce, but I'm still not ready to buy. And then we got inside bar and then a bear bar, and maybe bad follow through after the 38 breakout, but not enough buying pressure to buy. And then we just sold off some more. Double top bear flag with 41 and 44. Now you got a triangle and then another bear breakout. But anyway, I think, for you to have a $2,000 profit on that buy, I think that's fantastic, right? But I think the point is that whenever you see an extremely strong breakout like that, especially when it gets especially strong at the end, and then you see a bear bar, you got to be thinking, this could be the end of the move. We could just go sideways forever. It's possible that we could just go sideways like we did in the E-mini, and then later in the day get trend resumption up. But I'm always going to get out if I see a strong breakout and then a decent bear bar closing on or near its low. I'm going to get out because there's too much risk of an endless pullback, and I don't want to give back all of my profit. So that kind of a pullback is just an exhaustion move after an extreme buy climax. There's also one other factor going on there I didn't mention, but we broke above 6,000, a big round number, and a lot of times the market will race up to a big round number, and then bulls will take profits and bears will sell. Here's the daily chart. It's also the top of a 2 or 3 week trading range, and it's stalled right at the top of that range, repeatedly trying to get above 6,000. Tried here, tried here, tried here, tried here, tried here, and it keeps failing. And that's an example of why it's sometimes useful to look at a higher time frame chart. Even without the higher time frame chart, this is going to get me out. If that doesn't get me out, 3 consecutive bear bars, I'm out. I'm never going to be holding along and that kind of a situation because of the risk of what took place, an endless pullback. From an always in perspective, it was neutral for the first 9 bars, and then bar 10, I thought it might be becoming always in long, and then bar 15, I said if the bears get a bear bar, we could get the high of the day and a reversal down. And I said the one thing the bulls needed to do was prevent the bears from getting that bear bar. And right in the final seconds, bar 15 closed at the open. It was below the open with 10, 20, 30 seconds to go. And then right at the end, it got right back to the open. And I thought that made it always in long. And you can see everybody bought on bar 16 because of that. And so I was always in long on 16. I would get out below 17. And I said you could buy the high 2 at the moving average, 27. But I thought we were going to go more sideways. I thought the day was probably going to be a trending trading range day, lower range, brief breakout, bad follow through, and then upper range. And 28 was not enough bars for our trading range, which means that if we get a rally, it's probably minor, and we're probably going to test down. So theoretically, if you get out below 18, you get long above 27, but I think you have to get out and short below 34, a bear IOI, second failed breakout 25. And would I buy above 45? I would not. So it's still short. I would get out of shorts above probably 57 and get long above 61 if I were trading strictly always in. And would I get out below 75, a failed breakout new high of the day? I probably would. Question, when should one get out after a disappointment bar, like bar 29? Okay, bar 29. Okay, question, I entered at the close of 25. So he sold. He saw this as an exhaustive buy climax, a failed breakout of yesterday's high, a failed breakout of the all-time high. And then he saw a second entry short below 25. And that's a reasonable short for a possible high of the day. I thought what was likely was we were going to go sideways for an hour or 2 or 3 and then decide between trend resumption up and trend reversal down. However, I think it was reasonable to short below 25. I also think it was reasonable to buy above 27. Had I sold below 25 for a swing down, and then I see a double bottom at the moving average with a good bull bar 27, I'm going to get out and I'll wait. And I might short again below 34, taking another chance. And if you did, the market was okay for another 20 or 30 bars. But in a situation like that, where it's unlikely to go straight up and straight down, I don't want to be too eager to sell. So had I sold below 25 and then it reversed back up at 28, especially with a double bottom 22 at the moving average, I'm going to get out. I might sell again 34, but I'd have to get out again at some point. I would not get out above 43, but I would get out above maybe 56 or 60. Okay, I found this week to be very difficult and lost almost every day this week. Any suggestions for trading limits at highs or lows? I think most traders had very little opportunity to make money over the past week unless they're willing to trade with limit orders. And I think unless you've been trading a long time, at least 2 or 3 years, It's really difficult to trade with limit orders. I've been trading over 30 years, and when the range gets to be mostly 2 points, maybe 3 points, I stop trading. And the reason for that is it's too easy to lose money. The risk is usually greater than the reward, and that means you have to win 70 or 80% of the time to make it worthwhile. It's not worthwhile for me to average a one tick profit, right? I need to average more than that, because if you're only averaging a one tick profit, even if you're winning 80% of the time, all it takes is one mistake, and all of a sudden you've lost. So you may have taken 5, 6, or 7 trades, and at the end of 5, 6, or 7 trades, you're down. And that's not what I want to do. That is a bad approach to business. That's a bad business model. And so sometimes I used to get upset and frustrated when the market would do this day after day after day. This, and then Tuesday, pretty small day, and then again small day here, and then small day here, and small day today. I used to get bothered by that, and on some level, on fantasy level, I was feeling like the world was punishing me for being a bad person or something, and it's not that at all. That's just the way markets work. And next week, the odds are we're going to get some big days, and they may be up, maybe down. The market's telling us that, at least initially, we're going to go up. It looks like we'll go above 2,500. And Wednesday has the potential to be a really crazy day. I mentioned over the past few FOMC meetings how the price action after the FOMC announcement has changed pretty dramatically over the past couple of years. Prior to a couple of years ago, there were a lot of very big trends after the FOMC announcement. But over the past couple of years, the market has either had a lot of big whipsaws, up and down, down and up, or it stayed basically sideways. So we may get more of the same on Wednesday with the announcement. So it may be pretty unremarkable. However, with the market rallying fairly strongly this week, near the top of a bull channel, at a new high, at a big round number, 2,500. The market's been trying to get above it for a few months. There's an increased potential for a big move. A bull channel, we've had 5 legs up, 1, 2, 3, 4, 5 on the daily chart. 75% chance we're going to get another leg down, and 75% chance that leg down is going to break below the bottom of the bull channel. So 75% chance before we go much higher, we're going to get below this bull trend line. 25% chance we're going to break above the bull channel and accelerate up into an even stronger bull trend. What no one is talking about is whether or not the market has already priced in major tax reform that is very favorable to the stock market, to the banks, and to all companies in general. And nobody knows. Nobody knows if this rally over the past couple of years, especially over the past 11 months, is already pricing in a big, very positive change in the country's policy. And if it has not, if this is not pricing in that big change, and instead is simply a reflection of current profits and and the performance of the economy, we could go a lot higher. Let me put up the cash index. All right. This is a bull trend that's going on for a long time, 8 years, and now it's the strongest it has been in the entire bull trend. And just like the NASDAQ 5-minute chart today, whenever you see the trend getting even especially strong late in the trend, it's more likely exhaustion than the start of a new stronger bull trend. And this is probably an exhaustive move rather than the start of an even stronger bull trend. However, go back to 1995. Okay. Market's been up from a lot of years. Here's the 87 crash. I'm probably the only person in the room who was trading during the 87 crash. And I can tell you that it was the most significant trading event in any trader's lifetime. None of us was around during the 1929 crash, but this was the most significant trading event in anyone's lifetime. When this crashed, it fell 26% in one day. And as it was falling, if you were listening to the radio, the report was something like, the stock market is falling. No one knows what the price of the stock market is. No one knows how far down the market is off the high, but everybody knows it's down a lot. That was the news. And you could not sell. There were no bids. The market went straight down. So every tick was below the low of the last trade. So if you were trying to sell, if you're long and trying to sell out, you couldn't sell because the market, no one was willing to buy. So if you were long up here, you did not get out until somewhere down here, 20% or so lower. And that was a really, really dramatic event. Are we going to get that now? Let me just say one other thing about that. When that happened, going into it, this was an impossible event. It could not happen, right? The market had rules and procedures in place to prevent that from happening. Yes, it happened. Yeah, it happened. 2010, we had the flash crash where the market lost, I think, like 5 or 6% in 20 or 30 minutes, and that could not happen. The market had procedures to prevent something like that from happening, but it happened anyway. And these things cannot happen again because now the market has similar procedures in place to prevent it from happening. Well, guess what? The 87 crash and the 2010 flash crash cannot happen. The market does have procedures in place to prevent those events. However, there are black swans and things happen that nobody expects. And there's nothing in place to prevent against things. You don't know what you don't know. And the market always can, if you think about it, the market can do almost an infinite number of things. And the exchanges can only make preparations for a finite number of things. And whatever you think is the limit of what the market can do is wrong. There is no limit. It can do anything. And even though the market cannot do the 87 crash or the 2010 flash crash, it can do all kinds of other crashes. And you want me to tell you about them? Well, I cannot because I have no idea what they are. Nobody can tell you about them. And if I could tell you about them, then the exchanges could figure them out as well. And the exchanges could put procedures in place to prevent them from happening. And that's the problem. Because I cannot tell you how another crash can happen, and nobody can tell you, there's no way to prevent that kind of event from happening. No one understands what it is. No one, no one knows what it looks like. When it happens, we'll all know. But if you look on television and you hear people say it cannot crash or it cannot do these things again, they're wrong. And if you trade the next 10 years, next 20 years, you're going to see another crazy thing. And you'll look at it and everyone's going to say, oh, that shouldn't have happened. Now we'll put new procedures in place to prevent it from happening again. And those procedures probably will be 100% effective. That particular crash will never happen again. But the market is always going to have crashes, and it's always going to find a new way to crash. Anyway, an 11-bar bull micro channel, very unlikely that we're going to get a major reversal, very unlikely that we're going to crash. But I don't say 100%, right? There's always a small chance that something crazy can happen that the exchanges have not expected, and we could just do something totally unexpected, and it could be huge. But the chance of it, what's the chance of it happening in the next month or so? probably less than 1%. 90% chance if we get a reversal, it'll last for 1, 2, or 3 bars, and then the market will go at least a little bit higher. What about the weekly chart being so overbought? Well, it's extremely overbought. However, it can get a lot more overbought. In 2003, the market stayed above the in 2003, the market stayed above the moving average for 50 bars. It got close a couple times, but it stayed above for 50 bars. Extreme behavior, and the more extreme the market gets, the longer it usually has to correct, and it ended up correcting for about 10 months, so sideways for 10 months. And this pullback does not look like much, but it's actually a 10% pullback. And I think that's what the weekly chart will do at some point starting soon. I think we'll probably correct for a lot of bars, at least 3 or 4 months, maybe a year. And it may be mostly sideways. However, it probably will correct down about 10%, which would be down to around the March lows. But no sign of a top yet. And right now we're trying to accelerate up. We're trying to convert a bull channel into a bull breakout. Here we're channeling up, and then we get a breakout. And the market cycle starts over again. We tried to channel up here. We got another breakout. And now we've been channeling up, and the bulls are trying to get another breakout like this or like this, and then start the market cycle over. So breakout and then channel again. And the odds are against it. Maybe 25% chance the bulls will be successful. 75% chance the upside will be limited, and the channel will continue, or we'll get a bear break below the channel and it will evolve into a trading range. All right, next week should be a really interesting week, so it's important to stay focused next week. I know this week, everyone, it's natural to feel bad. The market, it's just hard to trade. You look at this and say, can I make a living doing this? No. Nobody can make a living doing this, so they cannot make much of a living when the market is like this. But this is not how the market's going to stay. And next week, I think the odds are we're going to get some pretty good trend days. Okay, hope everybody has a good weekend.